Hi, Jim Yant from Golden Years Advisors, the home of the Kairos Formula. This is our fourth and final update in our fourth quarter State of the Market update. So let's talk what we've tried to put off, government spendings, debts, and deficits. Because as we all know, Washington has been in a gridlock trying to pass some of these key parts of the Biden agenda. So let's jump into the charts. First, on the left, what we see is this is the 2022 budget proposals as the Congressional Budget Office, the CBO, is putting forward. It's about $5.5 trillion of spending, of which 21% of it is funded by borrowing. And you look to the bottom of that CBO estimate, you'll see that this year they're assuming about 6% GDP growth. We told you it could be a little bit less than that. But as we go forward to the right in future years, they're doing a faster deceleration than we hope happens, but it will get to sub 2 levels. On the right side, what you see is first the deficit as a percent of GDP. This is without the current proposed legislation. So it's without the bipartisan bill and the quote reconciliation or the human infrastructure bill. But in 2020, during the pandemic, we had over a 14% to GDP level of deficit. The year we're currently in, it slowed down a bit to about 12-ish%. And then you see the dotted line, everything to the right is the glide path forward without that legislation. Now, the good news is all of the two different infrastructure bills that are being discussed and negotiated and fought over, first off, they're smaller than where they originally were. The bipartisan one is a $1 trillion one that is agreed to, but it's only about $550 billion of quote new spending. And originally the first of the quote human infrastructure or reconciliation bills was north of $3.5 trillion. And it seems like it's going to come in, if it gets passed, somewhere about $1.5 to $2.2 trillion. The chart in the upper right corner does not reflect that. But if those things get passed, most of those are over a 10-year time period. So as you see in the charts, there's a big reduction on a percent deficit per year. If those things pass, it'll be spread over the 10 years. But without those legislations passing, we're already looking for next year about a 4.7% deficit on a GDP basis that drops a bit but then accelerates up. We've said in the past, like a consumer, the government has lots of assets. The United States has tons of assets. Like we don't value our real estate, for instance. We just look at incomes and tax revenues. So we can handle something in the 3 to 4% level of deficits. But when it climbs much above 4%, it's hard to sustain that because our growth level on a real basis has been like 2-ish. So that is a mismatch that just won't work. On the lower right quadrant, what you see is how big is that debt, that total debt, and we're approaching 100%. You see on the chart, without the legislation, it'll drop for a bit, but then it's going to creep up. So this is a real issue. Let's wait till it passes, whatever passes, and then we'll give you a very detailed update on debts and deficits. But once looking at that big debt number, we know there's only 3 ways you get out of it. You either have to grow your way out, and you see on the GDP forecast, we're decelerating now from all the stimulus that we've done in the last year or two and will continue, or you have to inflate your way out. We've shown that we are going to have higher inflation at least through next year and potentially above 2% heading into the next presidential election. So some of that's going on. But the only real way you change that is you have to raise taxes. And as we've said over time, we're low from a historic level of taxes. So we think we could handle it if there's an increase. It's just how much and who pays. So let's have a quick update on taxes. Once again, until things are passed, it's too early to tell. But in the upper left, what you see is the 2 different changes really that Biden is putting forward, and we'll see what gets passed. But one is a rate hike for corporate taxes from 21% to 25%, and then to the right, a minimum tax so that corporations can't pay nothing. And you put it together, it's about a $10 earning per share hit, which the market really has already priced that in. So that shouldn't share or shock you. And if you look to the upper right, you'll see that to the far right, both NASDAQ and high-tech companies are some of the lowest tax rates on an effective basis. It's really the other parts of the economy that picks up more of the burden. Why there's such a discussion about taxes is the lower left quadrant. What you see is all the historic tax bills and how big of an increase it was on a percent to GDP basis. And what you see is the bottom three brown lines really is one, the Biden full agenda, and you see it would have been the biggest one ever, but that's not happening. It's the next two brown bars beneath it. And it's that infrastructure, but whittled down and renegotiated, as well as the bipartisan. If you still add those two infrastructure bills, it will be one of the biggest, if not the biggest of all time. To the right, just to tell you what that means from a competitive perspective, we have brown bars again. The far right brown bar is what happened after the quote Tax Cut and Job Act. Some people call it the Trump tax cuts, which made us far more competitive with the rest of the world, particularly large European countries, industrial countries. The brown bars to the left show what would happen whenever the Trump tax cuts expired, and the bar to the right of it is if those two infrastructure bills happen. So to me, it's a way of calming down, because if those two bills pass, it's really not as bad as just if the Trump tax cuts expired. And that's how Wall Street feels about it. So stay tuned, we'll give you more detail once we see what Washington passes. So in summary, across all these state of the markets, the recovery has been very bumpy, but it continues to strengthen as our war against the pandemic and COVID and even therapies against it increases. And so our expectations, and really the market's expectation, is a self-sustained recovery that goes multiple years. That's the update. If you have any questions, we look forward to meeting you in our one-on-one meetings. Have a great day and stay safe.